In today's video, you'll find what are the 3 best stocks that you can buy in February 2023 if you want to receive a lot of potential growth and a lot of passive income from those companies. So, if you're looking for the best discounted companies that have a lot of potential for 2023, well, you found the right video. Starting with my pick number 1, which is Apple with the ticker AAPL. The Big Apple logo is worldwide recognized as being the world's largest company with a market capitalization of over $2 trillion at the moment. But more recently, this American multinational acting in the technology sector created in 1976 by a certain Steve Jobs has seen a boom in their valuation in January 2023 where it has gained over 10% of value. However, over the last year, we can see that this company has lost about 15% of its total valuation and is currently trading with a super fair price to earning ratio of about 25. But now, let's see why this company could see a lot of growth in the upcoming years. Over the past decades, we've seen that Apple has been shut to the eyes of the public, notably because of their famous strong branding with the Apple logo for their iPhones and their MacBook. But over the last couple of years, we've seen that they have gained a lot of popularity with different other services. For example, they have their famous Apple Store sales with many different other subscription services like Apple Music, Apple TV Plus, and Apple News Plus. And they also have their cloud services that have been growing pretty fast over the last couple of years. All of these products and services combined with their special pricing strategy have helped them to generate slightly less than $400 billion of revenue in 2022. In fact, over the last 5 years, they've saw an annual growth in their revenue of about 11%. But what has helped them a lot to increase massively their revenue over the past couple of years is notably their strong branding. In fact, over time, this company has been able to differentiate itself from its big competitors such as Dell and Samsung, notably because of the high quality components that they have in their electronic accessories. Over the years, this has helped them to generate and create a strong fan base of people that will always be loyal towards them and that will always, for example, buy the newest iPhone. And this has notably helped them to increase massively the price of their different products, which are now considered by many as some luxurious products. So on one side, it is pretty positive for them since they don't have to sell a lot of quantities of products to make the same profit as their other competitors. But it also has the impact to affect the lower and the middle class that now have many different other alternatives. And so it's why many people will not want to buy Apple because of the high price and will prefer to buy on their competitors. Over the next couple of years, Apple has said that they wanted to expand their business model to different other sectors of the economy. For example, they want to create their own electric vehicle cars. So it's going to be very interesting to see how they will adapt to other big competitors, for example, in this market, such as Tesla and NIO. Another great news for the investors is that this kind of company is often considered by many as being a consistent grower, as we've been able to see over the past couple of years. And despite trading at some lower price at the moment because notably of the global economic conditions that we've saw in 2022, we've seen that they have been able to achieve some pretty strong earnings over the last year. But now let's see what the financial metrics are telling about this company. In terms of valuation, as I told you earlier, this company currently worth slightly over $2 trillion with a pretty fair price to earning ratio of about 23 compared to the average of the industry, meaning that this stock would currently be fairly valued at the moment. Over the last 12 months, we can see that they have been able to generate some incredibly high profit and operating margin, as well as a tremendous return on equity of about 175%. Over that same period, they've been able to generate slightly over $394 billion with an increase of about 8% in their quarterly revenue in the last quarter of 2022 compared to the same quarter in 2021, and with a slight increase of about 1% in their quarterly earnings. Unfortunately, we can see that this company has way more debt compared to what is its current cash position, and for the volatility of the company represented by the beta on a 5-year period, we can see that this company is slightly more volatile compared to the average market with a beta of about 1.27, which has resulted over the last 52 weeks of a loss of about 16% compared to about less 10% for the overall market. But the good news for the income investors is that they are giving a great annual dividend yield of about 0.63% with a pretty low payout ratio of only about 14%, meaning that they are already not using a lot of their net income to pay the dividends to their different shareholders. And finally, over the last 3 years, we can see pretty great growth in their total revenue, which has obviously been reflected in their total growth in their earnings before interest and taxes. And it's pretty much the same for the cash flow, where we can see that their operating cash flow have been increasing over the same period, which has obviously led to an increase in their free cash flow. Now for my second pick, I've chose the ASML company with the ticker ASML. This Dutch multinational is currently one of the world's largest producer of semiconductor chips, and with the recent shortage of microchip that has been created by the pandemic, we've discovered the importance of those little equipments in our life. One of the main fields that has been touched by this shortage is notably the automobile sector. For a few years now, we've knew that we were going to a shift towards the automation and electric vehicles. However, the problem is that this shift requires more chips, which obviously add the impact to increase massively the demand for those microchips in this industry. And with the microchips shortage that could continue over the next 2 or 3 years, this will obviously put a lot of pressure on companies such as ASML, which will see an increase of their demand for their different products, especially knowing that those microchips are pretty much needed in everything that is electronics. So at the moment, most of the products that you're using that are electronics are using microchips. But now, how does this company is able to generate their revenue? Well, most of them is actually coming from the sales of their little machines and their different microchips processors that are sold to different companies in the same sector. For example, companies such as Intel and TSMC. And on their part, those companies will manufacture those products that will be used, for example, for cell phones and laptops. But ASML has one major competitive advantage that its other competitors doesn't have, because it is the only company in the world that makes a tool called an extreme ultraviolet lithography machine that is actually required for the most advanced chips in the world needed for the different Samsung and Apple phones. Imagine how it would feel if you wouldn't be able to use your phone anymore. In any case, in the upcoming years, ASML should see a lot of progression, notably because of the needs that people will have for this kind of company. And they've recently announced that for the last quarter of 2022, they've been able to beat both the predictions for the revenue and the earnings. Plus, the growth of this company is far from over, since they are forecasting a 25% increase in 2023. All of this has helped them to generate slightly over 21 billion euros of revenue in 2022. But now, let's make a quick fundamental analysis on this business. In terms of valuation, we can see that this company currently worth slightly over 267 billion euros, with, however, a quite high price-earning ratio of about 42. But what is incredible about this company is their insanely high profit and operating margin over the last 12 months, with an incredible return on equity over the same period of about 60%. And over the last year, we can see that they have generated slightly over 21 billion euros of revenue, with a 29% increase in their quarterly revenue growth over the last quarter of 2022, and a slight 2% of increase in their quarterly earnings growth. And the good news for the investors is that this company currently have a lot more cash compared to what is its current debt. And over the last 5 years, we've saw that this company is way more volatile than the market, with a beta of about 1.19. But in the last year, we saw that it hasn't lost much value, with only a slight loss of about less 1.45%, which is way better compared to the less 10% of the market. And this company is also giving a great 1.50% of annual dividend, with a pretty good payout ratio of only about 45%. Over the last 3 years, we can also see a pretty great growth in their total revenue, which have been reflected in the progression of their earnings before interest and taxes, and their operating cash flow have also been massively growing over that period, which have been reflected in their free cash flow progression. And finally, for my third and last pick, I've chosen a company that is perfect for you if you want to fight the high inflation and a potential recession, and it's why I've picked ExxonMobil with the ticker XOM. This American multinational International is one of the world's largest oil and gas companies on the stock market, with a valuation of close to $500 billion at the moment, and it's a business quite interesting for both income and growth investors. In fact, as I just told you, the oil sector is often considered as one of the best hedge against the inflation to protect your finance. Economists are often using the price of oil as a perfect indicator for the inflation, and often when the gas price will rise, it will have a domino effect. The shipping price will increase, which will lead to higher end consumer prices. And obviously this has been reflected in the valuation of this company that is up of close to 10% since the beginning of the year. Personally, I think that the growth for this kind of company is far from over, and with a great 3% dividend per year, it is also a great company to keep an eye on for the dividend income investors. And as being the largest gas station service in the US, it will obviously benefit from the rise of the oil price. And despite losing a little bit of its value when the price of oil is going down, with a current price to earning ratio of less than 10, it is definitely worth to keep an eye on this stock. But ExxonMobil isn't just a simple gas station company. In fact, it is implied in all the different streams of the production process. But you might be wondering, hey, but Louis, with the climate change, don't you think that there are better companies to invest in at the moment? Well, even if the oil production is the main operation activities for this company, they are also fully engaged into the transition towards the green renewable energy. In fact, to adapt to tomorrow's environment, they have notably adopted many different emission reduction plans for 2030. Plus, recently, we've seen that they have had some pretty strong earnings for 2022, which is showing that they are still being able to beat the predictions of the analysts for the revenues and the earnings. But now, let's see what the financial metrics are telling about this company. And for the valuation measures of ExxonMobil, we see that the company currently worth close to $400 billion at the moment, with a super low price to earning ratio of about 10, meaning that this stock would currently be undervalued. We can also see that this company has some great profit and operating margin over the last 12 months of about 13 and 16%, with an excellent 30% of return on equity. And with the revenue of close to $400 billion over the last 12 months, we've been able to see a massive 48% of increase in their quarterly revenue growth in the last quarter of 2022, and an insanely high increase in their quarterly earnings growth of close to 200%. Unfortunately, it is another company that has more debt compared to its current cash position, and for the volatility of the company, we can see that it has been more volatile than the overall market with a beta of about 1.10, but over the last year we saw an incredible increase of about 52% in their valuation, which is extremely great compared to the poor performance of about less than 10% of the overall market. Plus, this company is also giving a massive 3.15% of annual dividend to their shareholders, with a super great payout ratio of only about 28%. And over the last 3 years, we saw an incredible growth in their total revenue, which has obviously led to an increase in their earnings before interest and taxes. And it's pretty much the same scenario for their operating cash flow that have been massively increasing, which has led them to receive some higher free cash flow. Now that you find what are the best companies that you can buy right now in February 2023, you might be wondering, hey, but Louis, what are the best ETFs to buy right now? Well, in that case, check out the video that's gonna be right over here, and I will see you soon. Peace!